Okay, so Tesla had a bad day today, and as the day progressed, Tesla really didn't get better, closing down about 3% today, a little bit more than 3%. We have some big events coming over the next couple of days, including Nvidia earnings. We have economic data coming out tomorrow, which could be important for markets. We'll talk about it, but I do think the main events of today were actually some very cautious Fed speakers, almost too cautious, like they're panicking, at least to some degree. And when it seems like Fed officials are to some degree panicking, that's not usually comforting for markets. So first up, as I explained in the last video, we did have Fed Barkin that said there is a risk that firms will resort to layoffs if the economy weakens. He also says that disinflation has spread beyond goods to the rest of the economy, boosting confidence that it will continue. Now, on one hand, layoffs, obviously not great. On the other hand, the Fed is expressing more confidence that inflation is really gone at this point, that it's no longer an issue that the Fed needs to focus on. But with disinflation or maybe even deflation, we'll see in the months to come, that's actually bad for corporate margins. That's bad for profitability. So while the Fed has been really looking forward to inflation broadening out and showing less strength, if we can use those words, it's not good for corporate profits. One of the reasons why corporate profitability has been so good in recent years is because of the inflation. Companies have been able to raise prices. And if companies are no longer able to raise prices anymore, then that obviously is not good for corporations. And also at the same time, if companies can no longer raise prices, that suggests the consumer is no longer buying those products at rates and volumes that they previously were, which suggests the economy is weakening, maybe across the board and not just in certain areas anymore. I also reported in the video earlier out today that durable goods orders month over month on the headline came in at 9.9%. We were expecting 5%, and last month came in at negative 6.9%. So you had stronger than expected durable goods. But did you really? When you look at durable goods orders, as Kathy Jones says on X, they rose more than expected in July, but the details painted a less rosy picture. Core capital goods shipments used for GDP declined by 0.4% for the month. So if you actually look at last month, you came in at 0%. The month before that, you came in at negative 0.6%. So the last 3 months have been bad. If you just want to net all of this, it's not getting better. It just looks like it's staying bad. And if you do look at this yellow line, which is representing the trend, it is definitely trending lower, hitting its lowest level you have seen in the last couple of years. So I do think that was also something that likely did have a negative impact on markets today, maybe just big tech, because in fact advancers are outnumbering decliners in the S&P 500 today by 4-1, yet the index is down and the Nasdaq is down 1%. All of the mega caps were red today, and I do think there is some anticipatory selling heading into Nvidia earnings, because Nvidia now at this point is back to yet again being priced for perfection. After seeing a large drawdown, I mean, you're back up to near all-time highs again. I think it's safe to say Nvidia is going to have likely good things to say and probably going to have good earnings. If Nvidia does talk about a potential slowdown in CapEx budgets from their clients, some kind of slowdown in future demand, that will be the biggest driver for Nvidia stock. And Nvidia will affect all of your other big techs. It doesn't necessarily need to affect small caps or mid cap stocks, but definitely big tech will be affected. That controls the S&P and the Nasdaq. The market on close and balance for the S&P 500 was positive 570 million. The Nasdaq 100 was positive 800 20 million. The Dow 30 was positive 25 million, and the Mag 7 was positive 260 million. Now, the market on close, as you can see here, this was posted on Financial Juice at 3:50 p.m. It's the last 10 minutes where all of the big orders for the end of the day go in and start to get finalized. So there actually was a bit of buying pressure in just most areas of the markets into the close of the day today. Fed Daily also had quite a few things to say today. She says, I expect growth to be at or below trend. She also says we have a long way to go, and even after cutting rates, we will be restrictive, which suggests that there's going to be many rate cuts to come following September, which again is one of those good news, bad news scenarios. Many rate cuts implies the economy is going to get worse from here. But many rate cuts also implies the cost of capital will be cheaper and maybe certain areas of the markets can do better. And this was definitely a scary quote. Fed Daily says we could see the neutral rate or the neutral real rate to be as high as 1%. So that implies that maybe there's not really much of an inflationary pressure in our economy, especially once we get inflation down, which means there's probably not that strong of underlying economic activity either. She says, I don't want to declare we are on the path to neutral, but that's basically what she did today. She says if the economy weakens more than anticipated, we would need to be more aggressive on cutting rates. She also says it is too early to know how big rate cuts will be, suggesting that 25 basis points may not be appropriate, that we may need to cut rates faster than that at larger intervals. Fed Daily also says, I am not hearing signs that firms are poised for layoffs. Fed Daily says the labor market is complete imbalance. And this was an interview on Bloomberg TV. And keep in mind, she was not on the economic calendar today. This was not a scheduled, thing from the Fed. She decided to go on Bloomberg and say these things, which Fed officials like to do this all the time. It's called jawboning. They try to create a narrative for markets to have markets price certain things in ahead of the Fed actually doing it. And most of these comments, I mean, pretty much all of these comments she made today are skewed towards an economy that's going to get worse, maybe a larger rate cut coming September 18th. And I think that's what she tried to talk the markets into today. Jerome Powell probably called her up and said, hey, we need you to go on Bloomberg at 2 o'clock and tell them, hey, things might be getting worse. We might have to cut rates more than expected coming September. Because in all actuality, I think the Fed is panicking right now. I think the Fed is panicking because they are so off sides with their policy, with their policy rate being where it is, and the signs of weakness that we are seeing, it is excessive. And I think the Fed wants to right size where they are without freaking out the markets. And I think right sizing where they are, or where they should be, is probably at a federal funds rate at like 3.5% right now. That's probably where Powell and other Fed officials would want to be if they could just snap their fingers and be there without the markets freaking out. I think they would take that deal any day. And as I have said many times here on this channel, it's going to be hard for the Fed to talk the markets into 50 basis point cuts, maybe repeated 50 basis point cuts, and have the markets believe that that's actually good, that doesn't mean the economy is falling apart. When you start to hear larger rate cuts from the Fed, you start to associate with that, oh crap, what is going on with the economy? For September 18th, there is currently a 71% chance of only a 25 basis point rate cut versus yesterday at 64% chance of a 25 basis point cut. So the odds of a 50 basis point cut actually dropped 7% today, and the odds of a 25 basis point cut rose 7% today. I think that's why Fed Daily went on Bloomberg to try to talk the markets more into a larger cut. Again, without freaking the markets out, telling markets that, hey, things are about to get worse from here. trying to talk us into that. And I will reiterate what I said in other videos. I do think the broader markets can do well in this environment as we look ahead towards rate cuts. If the economic data comes in good, yes, there can be political uncertainty and volatility. September is historically, over the last 10 years, by far the worst month for stocks. Like on average, September, you actually see a drawdown of about 2.9%. No other month of the year is negative besides December, and you're only negative like 0.2% on average over the last 10 years. So September is a standout terrible month. If seasonal trends do start to play a role, then sure, you could get some weakness. But I think the underlying kind of fundamentals, what we've seen recently, would actually favor a broadening out of this market sooner rather than later. But I could be wrong there, and that doesn't necessarily have to happen. But as I have said in a couple of the last videos, I am nervous about the markets over the next 3 to 6 to 12 months because of this. From Lance Roberts, that says he is the chief strategist at RIAadvisors.com. He says the market is currently pricing in a 0% chance of a recession. 0% for the S&P 500. 0% on August 5th when markets were selling off, down 10%. 0% right now. Whereas if you look at other areas of the world, even fixed income, A-rated bonds are pricing in a 14% chance of a recession. On August 5th, they were pricing in a 39% chance of a recession. August 5th was the day we hit that low. The Japanese carry trade was imploding. Triple B bonds were pricing in a 20% chance of a recession August 5th. Today, they're pricing in a 0% chance of a recession. Like, if you look at Europe, you're pricing in a 100% chance of a recession. This is mainly based on multiples of markets and what markets are paying for them. Oh my gosh. Emerging markets are pricing in a 80% chance of a recession. August 5th, they were pricing in a 91% chance of a recession. Like, the rest of the world is pricing in a good chance of a recession. The US is not. So can we really sit here at markets and say, based on the data that we have gotten recently, some of which has been very recessionary in nature, and others that have supported the economy is doing okay, can we really sit here and say the markets are appropriately priced for both sides of that? No. And then you have to think to yourself, what are markets least priced for? They're least priced for a slowdown and or a recession. That's just factual. So whenever the markets are priced more in one direction, it usually pays to be that contrarian and say, hey, could we see more of a pricing in of the other direction over the next couple of months? And the answer is yes, meaning in simpler terms, you're likely going to see recession odds rise as time goes on. And that's negative for equities. But that's usually not a fast process. It usually takes some time for markets to adjust to new environments, maybe more recessionary environments. It just doesn't happen in one day. It takes time. Zero Hedge writes on X, RV downturn turns apocalyptic, with the largest dealership offering 55% discounts. Goldman Sachs is estimating the go-forward break-even rate for the economy for jobs is about 160,000 jobs a month, assuming we have 1.5 million net new immigrations in 2025. Goldman Sachs also writes here, the soft landing lands a soft blow against the dollar. It says, dollar weakness has come alongside a recovery in risk sentiment and higher equity prices, which typically doesn't happen. You typically see the two follow each other. Bar chart on X says U.S. government debt as a percent of GDP at the highest levels since World War II. We're probably fine. And if you're an investor in Tesla stock specifically, in which you probably are if you're listening to this video and you're subscribed to the channel, hopefully you're subscribed, Jim Cramer believes Tesla is a strong stock, so we may be completely effed in the near term. Perhaps that would make sense why Tesla underperformed so much today. And here's another one of those just data points that suggest the economy is not doing good. 11% of credit cards are delinquent 90 days or more. Past surges showed an economy which was already in recession. If you look at 08, 09, I mean, when you went into the 08 recession, you were only at about 9% credit card delinquencies past 90 days. By the end of the recession, you were at about 12%, so a little bit higher than where we are now. And then you peaked at about 14%. But this is just bad, okay? This is not good at all. And when the economy is 70+% based around the consumer spending money, and these citizens, a good chunk of them are maxed out on their credit cards, there's literally no more spend to spend. How long can economic activity hold up in that environment? Probably not that long. And that's why I'm more worried about the next 3, 6, 12 months from now, not as much worried about the super near term. I explained this in previous videos, but I think there's a massive lag in the data. I think what we're seeing in the economy now will be reflected in data probably 6 months from now, 3 months from now. That's just my speculation. That's what it looks like to me. And if that's the case, the end of this year could start to look much worse. Hedge funds are on track to sell equities this month at the fastest pace since March of 2022, according to Goldman Sachs Prime Book. You really haven't seen anything like this since the beginning of 2022. And again, I think that's just unfavorable risk to reward dynamics. There's not that great of a chance that growth surprises to the upside compared to expectations. There's a much greater likelihood that growth disappoints to the downside, and that we do or will be forced to price in some recession risk. And apparently sausage sales are being used as an economic indicator within the Dallas Fed. It says here, for food manufacturing, we are preparing for the recession. As the economy weakens, we are seeing modest growth in our category of dinner sausage. This category tends to grow when the economy weakens, as sausage is a good protein substitute for higher priced proteins and can stretch consumers' food budget. At the same time, Bank of America's Sutmer says hold on for SPX 6,000 plus by August 2025. 12 consecutive months of positive year-over-year returns point towards 6150 by November 2025, original April 2024 report. I may have underestimated the strength of this bull and not considered market's ability to anticipate lower rates, expanding multiples, and earnings growth. I'm a technician after all, not a fundamentalist. You also have Ed Yardeni that says Powell was unambiguously bullish for stocks. Furthermore, stronger than expected economic news is likely in coming weeks. We are sticking with our roaring 2020s base case, targeting the SPX at 5,800 by the end of this year and 6,300 by the end of next year. But again, we have really bad data at the same time, and people are just super bullish. And hey, maybe that will prove to be the right call, but the risk is way too high to ignore the bad data, right? And people are doing that. This period reminds me a lot of the complacency you had in 2007, where, you know, after Jackson Hole in August, there was this consensus that everything was going to be fine. There was going to be a soft landing. 2007 and 1995 were the only instances where Jackson Hole were actually positive events for markets. And then what happened? By mid-September, Lehman Brothers went bankrupt, and the whole system came collapsing down less than a month later. Now, I'm not saying that has to happen this time, just like it did then. I don't think this is going to be like 2007 in that sense of, you know, mortgage crisis and all of that. But, you know, over the next 6 to 12 months, even 3 months, could you see consensus be proven very wrong? Probably. That's most likely, in my personal opinion. Even if we never avoid a recession, I do think everyone being bullish like they are now is way off sides. And I would feel a lot more comfortable about markets if some people were bearish. We have seen a sharp increase in large speculators, aka hedge funds, that are net short in positions in S&P 500 futures. Funstrat writes on X, a pushback to new highs is underway but should prove short-lived into September. S&P has officially formed 4 waves out of 5 and is now embarking on the final push higher into September ahead of a seasonal correction. So that's actually interesting that even Funstrat, Tom Lee, Mark Newton, Funstrat, like the Funstrat, thinks that we're still heading for a seasonal correction. And I think most investors would disagree and say, we're probably not going to even get any significant downside from here. And again, I don't know if that's going to happen, but I do think the risk is a lot higher than Wall Street believes it to be. Now, personally, today we just had a meeting at the restaurant that I work at because sales are plummeting. And it's not because food is bad, service is bad. It has nothing to do with that. It has to do with people are broke. People are out of money. When people are going to a restaurant, they want value. They want to walk out of that restaurant and say, I paid $50 for my family to have a meal, or $40, whatever it is, for dinner. That was a good deal. People want to feel like they are getting a good deal. If you are not able to give, people good deals, you're not going to sell things. And even then, there's only so many people that can even afford a good deal right now. And yes, the restaurant today is going to start laying people off, reducing hours. Even if you don't get laid off and your hours are reduced, then that's less money that each worker at this said restaurant can, spend on other things, right? That's less money they're going to take in. And then think about that on a collective level across America. That becomes a much bigger problem than just one restaurant, one company, or one business here or there. And it does appear like that's the direction that we are headed down. But again, with the data being so lagged behind, I don't think the things I'm seeing in real time will be reflected in the economic data for months from now. That is, after all, why they say jobs reports are lagging indicators. Now, here is the lineup for earnings this week. Tomorrow, in after hours, you have Centennial One, PVH, Box, and some others. Wednesday pre-market, Abercrombie & Fitch, Chewy, Kohl's, Foot Locker, RBC, and JM Smucker. Wednesday and after hours, your big dogs. Big dog, Nvidia. You also have some other big companies like CrowdStrike, Salesforce, Affirm, Okta, Pure Storage, Viva, Five Below, HP, and NetApp. Thursday pre-market, you have Best Buy, Dollar General, American Eagle Outfitters, Ollie's, Campbell's, Burlington, Birkenstock, 1800 Flowers, and some others. And then Thursday and after hours, you have Dell, Lululemon, Ulta Beauty, Marvel, Gap, Autodesk, and MongoDB. So I do think it's possible that we get some weakness heading into Nvidia earnings. Say, uh-oh. And as far as economic data coming out tomorrow, 9 o'clock in the morning, you have S&P Case-Shiller home price month over month and year over year. I think that will be important. We'll see if home prices start to fall. That could be a problem for consumer spending. That could be a big problem. The biggest thing people look at when they think about consumer spending behaviors, apparently, I don't know if this is true. I don't personally buy into this, but according to the data, personal spending behaviors are very correlated to their home values, okay? I don't look at it like that. You may not look at it like that, but I could see maybe how average people could say, hey, my home's, not doing so well. It's losing value. Maybe we should pull back spending. I could see that potentially, but, it's to be determined. We'll see. Obviously, 07, 08 had that effect, but people also lost their jobs during that time. Now, you will get the CB consumer confidence that will come out at 10 o'clock in the morning tomorrow. I think that will be important. There's many different subsectors of this survey that Wall Street will break apart. You have Richmond Fed Manufacturing Index, expecting that to be negative 15, a little bit better than last month's negative 17. Richmond Fed Services revenue is expected to be positive 4, a little bit worse than last month at positive 5. Dallas Fed Services expected to be negative 0.2%, a little bit worse than last month. And that's pretty much it for tomorrow. But again, I just think there's going to be a lot of preparations for Nvidia earnings, reducing some risk. There's going to be maybe some short positions being taken out on big tech potentially following today. We will see. I will also point out the S&P did close under $560 for the SPY, which is not a great sign for tomorrow or really for the bulls at this point. I wanted to see a strong close above 560. Tesla stock, as I said previously, just had a really bad day, and honestly at this point staying above 210 would be good news. Here in after hours you're trading at $212.74 per share. You did bounce at this 20-day moving average around 210.88 today, so that was definitely good news, but I'm not convinced that's going to hold if Tesla's grouped in this big tech category. You know, sometimes Tesla trades like a big tech stock, like a, you know, Mag 7, if you will. Sometimes Tesla trades like a small cap. And today it traded more like a big tech stock. And ultimately, if we do get more downside, that 200-day moving average at about $203 or so is going to be critically important to hold. If we don't, then you start to target lower levels like 195 or ultimately back into the 180s. But I do think, again, the case for a broadening out of our markets, the case for small caps, interest rate sensitive, dividend, value stocks is pretty strong here until the data in the economy weakens further, or until the Fed freaks markets out, until Nvidia misses on earnings potentially, you know, on Wednesday. Until something happens that's negative, I do think there is room for Tesla to do well. And there is room for small caps, value, dividends, cyclicals to also do well. So I would warn you in drawing any definitive conclusions on what the near term could look like for markets. Again, we have the factors in which that should propel the areas that I just mentioned, small caps, cyclicals, value. For obvious reasons, those can do well right now. But then you are also butting into seasonally the worst month of the last 10 years by a long shot. Like the last couple of years, 5 years in a row, in September, you've been down more than 5% in the S&P. Like, that's a lot. That's bad, right? So you're butting into that. That can definitely just cause some nervousness, and, you know, patterns that repeat themselves tend to keep repeating themselves. So I would warn you in drawing any definitive conclusions, again, in what's coming next in the near term. But I do implore you to be ready for whatever outcome we do have. And I will tell you, I think there's going to be a lot of volatility. I don't think the volatility was just as short-lived as this 10% correction and it's all going to be over with. No, I think there's going to be a lot of volatility for maybe the next 12 months, maybe longer than that. And you need to be mentally prepared for that as well. So let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel. I know I just threw a lot on you, but let me know what you think. Also, let me know what you are experiencing in your real world economy. Are you getting your hours reduced? Are people you know getting their hours reduced? Are they outright just getting laid off? Let me know what's happening in your world down below in the comment section. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.